Hello everyone, and welcome to your Glassnode video report, where today we're actually going to be surveying the sell-off which is currently in motion at the time of recording. So we've seen Bitcoin sell down under 38,000. So what I really want to explore here is a bit of a view on what I use in terms of the tools to assess what is going on under the surface. So in order to achieve this, it's very much about understanding the mechanics of the sell-off. What could be the driving forces? What type of actors and cohorts could be potentially providing that sell side or demand side? And essentially trying to understand what is pushing prices down. Are we seeing this in derivatives markets? Is it driven by spot markets? What can we tell using the data that's available to us? So we're going to do everything from big picture supply dynamics, have a look at a little bit of the spending that's going on chain and the realized profits and loss, and then look into the derivative side of things to see whether we've got some kind of a leverage flush that's really pushing this market around. So let's get into the charts and get started. So to really set the scene, I want to start with our percent of supply in profit. Now, the primary reason that I'm looking at this is just at a very, very big picture. What we can see is that our current level of profitability is at 67%. So what that means is that the other 37% of the supply is currently underwater. That means that they were purchased at a price that is higher than the current price. Now, as prices fall, it obviously creates a psychological barrier. It's the further that prices fall, the more that people just want to get their money back. So the more coins go underwater, the more likely we're going to have headwinds on any kind of bounce higher, because those investors are going to at some point want to get their money back. Now, some of them may turn into longer term holders and actually be quite happy to sit there and wait for higher prices, but there will be another set who are either waiting for some kind of a bounce to take liquidity off the table, or perhaps are then going to provide additional sell side as price goes further down. So one thing to note before we get started is really that we're at a profitability that is very, very similar to July. So the take home from here is that this level has been defended in the past. However, to then come back and retest that level, even though we're 38,000, this was down here at 29,000, so there's roughly $9,000, $10,000 in difference. The level has been defended before, but trending lower than that would again put more and more of these coins underwater and therefore create additional sell side. So it's very much about assessing these risks. So if we look at something like our balance on exchanges, this is often a metric that you can just look at for the big picture. I've got it quite zoomed in here on a 1 hour resolution to just really understand what's going on. So a intuitive view would be, well, if we're getting sell side, that must mean that lots of coins are flowing into exchanges. But what we can actually see is this is the last 6 months, and you can see that really the balance on exchanges hasn't changed a great deal. It oscillates here and there. We get some periods of outflows, and then we get also periods of inflows. But on a macro scale, really since September, we've basically seen exchange balances trade sideways. So for every net inflow, there's more or less a net outflow. And right now, we're not seeing a great number. You can see the price has declined, but we haven't seen some kind of major inflow that perhaps is triggering this. So at the very early level, we're not seeing a massive inflow to known exchange balances to really drive this. So we can kind of put that as a maybe, but it's also not at the moment looking like we've got some significant inflow. And what is important, let's actually drag this out just a little bit more. We can see the big difference that we saw back here in May, right? This is a significant inflow. We can see that this is a characteristic change, which simply doesn't seem to be reflected here. So it looks like there's a different mechanism that's currently at play. So my first port of call is then to look at, okay, who are the highest conviction market participants in Bitcoin? Now, typically speaking, we look at things like long-term and short-term holders, and we use the concept of dormancy, lifespan, how old a coin is, as a proxy for people who have weathered volatility and are more experienced. Now, the metric I have up here is called liveliness, and this is actually one of my favorite metrics. It's a very big picture metric, and what it is looking at is a global ratio. So across all of Bitcoin's history, it looks at all of the coin days that are destroyed. And remember, a coin day, for every 1 BTC, it will accumulate 1 coin day per day. It's a measure of how dormant the coins are. So for every day, every coin in the supply will generate 1 coin day. Some of those will be spent, and that will destroy and reset those coin days. So what liveliness does, it will trend lower when there are more coin days being created than destroyed. When will that happen? During accumulation and periods of hodling, because fewer people are spending their old coins and they're putting new coins into cold storage where they start accumulating lifespan. So liveliness trends down during accumulation periods. It will trend up when coins are distributed, which is typically during bull markets. And the steepness of the curve to the upside means lots of old coins are coming back to life. You can see after February, fewer old coins came back to life, but there was still plenty of spending going on. And likewise, the steeper the downtrend, the more hodling. So right now, you can actually see that this is actually accelerating to the downside. So on the very, very big picture, there's actually more hodling going on than coin day destruction, which is interesting. So even though we're seeing downside price correction, to be honest, it's not as if people who are in this market aren't aware that prices are down. This has been going on for a number of months now, since November. So it's not a surprise that markets are going down, and yet we're still seeing this accumulation behavior, which again looks a little bit like what we saw back here in 2019, which can take some time to play out, but this is the general big picture. So we can also see this in our long-term holder supply. So here I have in the blue is long-term holder supply. We'll look at short-term holders in a second. The dark blue are long-term holders in profit. Light blue are those that are in a loss. Now, some observations here. And again, I've got the 2017 all the way through to our current market cycle in show. And you can see that the distribution, right, when we have these long-term holders spending their coins, selling them to new short-term holder hands, they get a decline in overall long-term holder supply. This typically ends around the peak of a market, and long-term holders transition back into the accumulation mode. And as you can see, all through 2018 and all the process of 2019 into 2020 was a massive bear market and accumulation period. It was one very long accumulation. Now, we saw in 2021, during the early phase of the bull, we had that very same distribution level. Note that the amount of distribution in terms of coin volume was or supply was less than what we had in 2017. So there was less selling. But what we've now seen is a fairly substantial amount of those coins. Many of these were purchased by institutions or in the GBTC arbitrage and various other acquisitions. And as we pulled into the all-time high up here in October and November, we had a little bit of spending, which is pretty normal. You can see here, as we broke the all-time high of previous cycle, 20,000, we had spending going on by long-term holders. But note how they slowed their spending. They spent a little bit, but we haven't seen a mass exit, which again speaks to that liveliness. And in fact, let's zoom in on an even shorter time frame. We can see we're actually starting to get a bit of a curl back to the upside. So because there's always coins that are migrating across that short to long-term holder threshold, what this is telling me is that there's less spending to offset that. So in other words, that hodling that we saw in the liveliness metric does appear to be a thing, and it's showing up in this coin supply of coins that are getting older than 155 days. So again, it's painting a story of conviction that remains below there. Now, if we saw long-term holder supply selling off and really, really declining during this sell-off, then you could start to think, well, maybe they're losing conviction and they're driving the sell side. But at the moment, there's not much evidence to say that that is actually the case. So then we can look at the short-term holder supply, which is obviously the other side of that equation. These are coins that are younger than 5 months. And as you would expect, short-term holder supply is the highest at the top because the long-term holders have sold to become short-term holders. And these folks generally haven't seen the same level of volatility. They're not as used to it. It's a new asset. Generally speaking, they're weaker hands and they are more likely to respend their coins. So during that accumulation period, we obviously see the inverse. Short-term holder supply gets absorbed by long-term holders, goes into cold storage where it starts to mature. We saw during the 2019 bear market where we essentially had this period of consolidation. Then we had the same effect. During the 2021 bull, we saw more old coins get spent, turned into young coins, and the market eventually topped. And you can see at the moment that the proportion of short-term holder coins in almost the exact reverse of what long-term holders were doing started to climb a little bit. Long-term holders spent, became short-term, but even this has started to plateau. Now, the important thing to note here is look how many of the short-term holders in the light red are currently in a loss. There's about 18% of the total coin supply held by short-term holders, and of that 18%, 17.4% are essentially holding underwater coins. So if we remember back to our percent supply and profit chart, that means that most of the short-term holders who purchased in the last 5 months are currently holding underwater coins. So it's starting to tell us that the higher probability here is actually that we've got short-term holders who are, in terms of the spot markets and on-chain, are the most likely to be creating some kind of sell side. I've now jumped across to the spent volume age band. So now what we're trying to do is unpick, is this actually the case? Are we seeing younger coins as the primary spending behavior? So what I've got turned on here, generally speaking, 1 hour and up to about 1 week are typically daily traffic. It's a little bit hard to measure those sometimes. You have to get quite into the nuance to understand them. So when I'm looking at short-term holders, I'll look at coins that are 1 week to 6 months. Now, the reason I look at that is up to 6 months is getting into that long-term, short-term holder transition. And when someone's held their coins for a week, it's not something that they've withdrawn and then sent to another exchange. And it's not a coin that's in transit. It's not going from one destination through a series of hops to somewhere else. After a week, it started to settle down. Now you can actually see during this sell-off specifically, note how we've had an expansion up to about 14% of the overall spending behavior on any particular day is currently being driven by these shorter term holders. So we are seeing, and note how it's larger as this correction continues to the downside. So we're seeing more spending the lower price goes, which feels a little bit like investor fear. So let's just look at the next side of the equation, which is the longer term holders. These are coins between 6 months and 5 years. And note how we simply don't have the same trend. Where do we see longer term holders start spending? Towards the all-time high. They started cashing out. This aligns with our long-term holder supply. There was more spending going on during the topping pattern, again showing that market experience that we expect from these longer-term holders. And there's reducing spending or limited of it as price corrects. So again, it's starting to form this thesis that the higher probability is that it's shorter-term holders that are spending. So in terms of the scale of the spending, what we generally look at, and we can use our May through June, July period as a good example of this. So what this metric is the net realized profit and loss. So we look at every single coin that's spent on this particular day, and we map out, was it in profit or in a loss? So if someone withdrew a coin at 10,000, spent it at 50,000, then it's realized a $40,000 profit. And conversely, when somebody had purchased it at 60,000 and then sells it at 30,000, there's a $30,000 loss. So what we saw through the May, June, July period are all of the top buyers from February all the way through to May, those who bought the coins at the top, and note these green bars, these high green peaks, are people who are realizing large amounts of profit, $5 billion a day in profit. This is supply that's coming back into circulation, and you need $5 billion worth of demand to come in and absorb those coins. So we can see that this is the bull. These are folks who are selling coins for a profit that requires demand to come in. The bull run starts to slow, and then we end up into this correction. And we had 1, 2, 3 very significant over $1 billion capitulation events. And these are essentially investors who did buy the top en masse, selling in a big flush. Now, when do these spikes typically happen? Well, the first one was on the first major sell-off. So essentially the first bottom that got put in down to 29,000, we had the most people spending during that period. There was another one when price tried to retest that low. And then the final capitulation in July also had a very significant, not quite $1 billion, $900 million. So typically speaking, we get these larger capitulation style events at the exact bottom. Now we can see that the December 4th, we had one significant correction. So this was a large realized loss, 2.1 billion. But note how we haven't yet seen anything quite of the same magnitude. So it may suggest that there's a lot of these shorter term holders, there's kind of two outcomes. They're either waiting for higher prices to sell, or they haven't quite reached the threshold where capitulation occurs. So there's a few headwinds in play for sure, given how much supply is currently underwater and being held by those shorter term holders. Now there is another outcome here, which is that perhaps after such a volatile 2021, many of the short-term holders who purchased up here may well have every intention to hang on to their coins and become long-term holders. Now that is a topic that we can go through in a different video, but what we're really looking at there is, and we have to look at things like the hodl waves and even just looking at liveliness, is telling us something that could be in play, but it will take a number of weeks, and we can keep track of that over coming videos. So now we're starting to get to the crux that there's a higher probability that it's likely shorter term holders who are actually those that are driving most of the on-chain or the spot selling pressure. So let's zoom in and have a look at our latest market structure. And you can see this is our short-term holder SOPR, spent output profit ratio. So this is similar to our net realized profit and loss, looking at all the coins that are being moved and spent, but it's looking at it as more of a ratio. So we're looking at what is the profitability of this specific cohort, short-term holders. And again, we can see that they were predominantly realizing losses during this bearish period. We moved back into a slight period of profitability, but really since late November, we've moved back into this regime of sustained losses. And you can see that generally speaking, these larger capitulation style events can tend to put bottoms in, but if they don't happen, this can carry on for a number of months. So really what we're seeing is that most of the spending that's going on at the moment on chain appears to be short-term holders. It appears to be longer-term holders are less concerned about the current price action, which is quite interesting to see. But certainly short-term holders are in the process of realizing these losses. And it is possible that there needs to be some kind of capitulation event, a significant downside move with the spending to almost set that floor price and set that bottom. And the very last chart that I want to look at on the on-chain activity side of things is the number of active entities. So there is two sides to every equation in markets. There is the supply side, which is what we've more or less looked at as the supply coming from long-term or short-term holders. And what we've really noticed is that there's not much going on. It's mostly short-term holders, but it's still not a great deal of activity. So therefore, let's just think about the other side of the equation. Do we in fact have a limited demand? And is price just correcting simply because the demand is not there to hold that support floor? And in this particular instance, we can see the bull market in 2017. We can see the bull market in 2021 and 2020. You can see how the activity, the amount of entities on chain, the excitement and the hype is quite clear. Now, also note during the bear market, we form this bear market channel. It's slowly rising, but it does speak to a more bearish trend. Fewer people care. There's less friends who are saying, hey, you have to get into this Bitcoin thing, and there's less media coverage. This is really what this speaks to. This speaks to the hodlers being the only ones who really remain. Now, you can see that we had some growth during the rally. Typically, price and activities tend to follow suit, but note that as the correction continues, the amount of activity is also declining. Again, it's speaking to this limited demand. As price falls, it's starting to suggest that probably the number one driver is just simply a lack of demand at this point in time. And you can see that this is in a similar level. This behavior that we have is very similar to our 2019 and our bearish trend through 2018. And it's very different to what we see in 2020, 2021, and 2017. So it does look a little bit more like a bearish trend, and we're essentially just seeing a lack of demand, and price is thus correcting in response to that lack of demand. So to close out, let's look at our derivative space, because quite often when we see these big price moves, people tend to look straight to the derivative space looking for some kind of a leverage flush out. Because what we've seen is that market structure has been changing, particularly since around 2019 onwards. Derivatives have taken a much, much larger role, and particularly during 2021 and now 22, derivatives are playing a significant part of market structure. Now, what I have priced here is our futures open interest, so the number of open contracts, and this is priced in BTC. Now, the main reason that I'm doing this is so I can remove the influence of coin price. So when coin price moves around, if somebody has a 1 BTC position open, that's going to change with the price. Now, if they're opening up more positions, it becomes much harder to understand, is the market opening up positions, or is it changing because coin price is moving up or down? So when we price it in terms of BTC, it becomes a little bit easier. Particularly look at the December 4th, we can see the leverage flush out. You can see this dramatic decline in open interest, which is showing that irrespective of coin price, positions were closed out. There is now less open interest. So it's easier to spot these leverage flushes. Now, the take home here is we still haven't seen it. You can see that our leverage flush really hasn't happened yet, even though we are at a very, very high level of total open interest, 380,000 BTC. And you can see most of the time when we get to these elevated levels, we typically get some kind of major correction. So this is something to pay attention to. There's a lot of open interest in the market, and a lot of it is actually driven by Binance down here in the pink. So what we're seeing at the moment is that there's a large amount of open interest, and we still haven't seen a leverage flush, which is quite interesting. Now, when we look to something like our perpetual futures funding rate, again, what this is looking at is how many folks are going long or short, and how is it moving the futures price relative to the index price or the spot price. So when it's green and positive, it's suggesting that more and more traders they're willing to pay an interest rate to go long. And for the privilege of going long, they're going to pay that price, which pushes this metric into the green. You can see that when it goes red, it's saying the opposite. People are willing to pay a premium or an interest rate for the opportunity to go leveraged short. Now we can see that funding rate is generally, it's not high relative to what we saw during the October and November all-time high. We're quite zoomed in here from August through to January. You can see we went slightly negative, which meant that there was a short side bias. As we zoom into our current price action, you can see that our funding rate, people were going long as price rallied, and it looks like that's actually getting squeezed out. So it looks like in the very, very immediate term, this is at the moment, looks like a long liquidation or a long squeeze to the downside. Now, just be aware, because we still have so much open interest, it could mean two things. It could actually mean that there's more flush that needs to happen, and this could in fact continue to the downside. It may also mean, note how we've gone slightly negative, if too many short traders continue to layer in, the probability of actually a reversal and a short squeeze still remains in the market, because as the market falls and falls and falls, traders get more confident, add bigger positions, they assume that Bitcoin is going to zero, and it can start to create the opposite effect. So absolutely, in the current environment, there are risks that the market can go in both directions, and we still have this leverage that's baked into the system. And really, we have to see which way it's going to move. So it is something to just be very, very aware of, that there is leverage creeping in. It's still in the system. At the moment, we've more or less had a reset of our long position. And really, to close this out, we can look at our futures long liquidation dominance. So what this is looking at is every single long that gets liquidated, or every position that gets liquidated on a day-to-day, are most of them longs or are most of them shorts. Now, what we can see is most of the current positions are green, and you can see that during the current sell-off, most of the liquidations that are occurring are long traders. So it's starting to look a little bit like those long traders are trying to catch the dip. They're essentially trying to step in front of a falling price, and as price keeps falling, most likely due to just a sheer lack of demand that we saw in our on-chain activity metric, what we're seeing is those long traders are getting squeezed out. That said, we still have this elevated open interest, and it does remain to be seen which direction that it may go. We have indications that it actually could go in either direction, but at the end of the day, what we're seeing is this lack of demand, particularly in our on-chain space. And I think that's the takeaway from all of this, is there just seems to be a lack of demand on a relative basis, and that is at the moment still declining even as prices fall. So thanks for tuning in for this video. Do let me know if you're enjoying this style of content where we go a little bit more into some of the mechanics of what's going on a particular day. We're certainly looking to show you how these tools work and just explore each metric so you understand what up, down, red, green, and sideways all mean. So do let us know what you like covered in the comments. Let us know what your favorite metrics are and things that you would like us to cover in the future, so we can really get around to exploring all of these metrics and showing you the way around. So thanks for tuning in. I'll catch you in the next video. Cheers.